Hello, and welcome to this installment of our Industry Leadership Series. I'm Brian Dobson, Head of SPAC and Disruptive Technology Equity Research at Chardan Capital Markets. And I'll start this call with a few important disclosures. During this call, we will not be discussing Chardan research. Any discussions about research should be coordinated between a participant and their respective salesperson. Our compliance team has asked me to read this statement for the investor call. By participating in this call, our speakers attest that they have not made Chardan aware of any potential conflicts, and they will not discuss any material, non-public, or confidential information that they are aware of that may breach their legal, regulatory, or fiduciary responsibility to any parties. So with that out of the way, we are exceedingly pleased to have Darren Jamison, President and CEO of Capstone Green Energy. We're looking forward to discussing the company's expansion in its energy as a service business, which provides green energy solutions benefiting both the planet and company P&Ls. So thank you very much for joining us this afternoon, Darren.
Excellent. Thank you, Brian.
Wonderful. So I guess let's kick it off just for investors that are not as familiar with your company. Would you mind providing a brief overview of your business model and the key revenue drivers that lead to profitability growth going forward?
Yeah, sure, Brian. Capstone Green Energy is a kind of holistic green energy company. Our core technology is a microturbine-based solution. But in general, what we do for customers is evaluate their energy requirements, both electrical requirements and thermal requirements, and we come up with custom-tailored solutions. And those solutions can be either a capital purchase or a energy as a service solution, which is kind of our new business model. But in general, we're about lowering their operating expenses, lowering their carbon footprint, and then providing resiliency if that's a requirement for the customer. So we like to say we help folks, save the planet and save money. And if you don't like the planet, you don't like money, then you probably don't like our product.
Great. So as you're thinking about the expansion of your energy as a service business, could you explain to our investors how that business works and how you see it evolving over time?
Sure. So we have different ways we look at our energy as a service model. We can kind of do asset management for our customers. So if they buy a microturbine through us or through one of our distributors and they want to add some battery storage or solar or whatever the turnkey solution turns out being or the microgrid solution is, we'll wrap that with a up to 20-year kind of life cycle guarantee. So we'll look at parts and labor as well as just scheduled and unscheduled maintenance and give them kind of the peace of mind of one price to pay on a quarterly basis to make sure that project works as advertised. And so we call that our factory protection plan. About half of our microturbines of the 10,000 units we've shipped worldwide are under long-term FPP. We think it's a very unique solution and again, provides that fixed cost, results that you can count on, peace of mind for our customers. We also have a global distribution channel that we do a lot to support. Obviously, we're in about 83 countries and we charge our distributors almost like a franchise fee. And that's another part of our kind of reoccurring revenue energy as a service model. Most importantly, though, is our long-term microturbine rental program. We've recently announced we're expanding that program to 21 megawatts, which we said we'd do by March 31st, which we recently announced we did. But that energy as a service long-term rental program is a really underpinning our future profitability. Our margin rates are over 60%. Our EBITDA results are over 90, and it's a long-term technology that we pay for in a few years. And so it's a great kind of reoccurring revenue asset for us. And more importantly, a lot of customers, whether they're oil and gas, whether they're hospitality, whether they're cannabis, or most recently for us has been Bitcoin, the chance to get into our technology, get this environmental savings, as well as the financial savings without the capital purchase up front is very attractive for our customers.
You touched upon recurring revenue streams there. Over time, do you expect that to reduce earnings volatility and increase earnings predictability?
Absolutely. As a small public company, we're selling $1 million pieces of equipment. Earnings volatility has been very challenging over the years, and so a lot of times we talk about a push out on a project or things got delayed. We just recently installed units at One Vanderbilt in New York and in Hudson Yards in New York. Those projects were sold 4 or 5 years ago, so it's very hard to predict when they're actually going to come through the P&L. And so by more reoccurring revenue, it's not only higher margin revenue, but it does give us better cash flows and more predictable revenue growth, which is key for everybody, especially being a public company. So today, over half our revenue is recurring, and we're obviously growing that as fast as we can to be even more.
Now, I suppose, do you think you could compare for us the returns on, call it, renting versus selling equipment outright?
Well, obviously, for us to sell equipment outright against, I call them, more antiquated, older technologies like internal combustion engines, like Caterpillar, or Cummins, or Siemens, it's very challenging. We're a smaller volume manufacturer selling against high volume manufacturers. So, not unlike Tesla in the early days, we're selling against Ford and General Motors, and Tesla in the beginning was almost a car hobby company more than a car manufacturer. So we're not that dissimilar. We're competing against some of the biggest companies in the world with older, antiquated technology, just like Tesla is doing. And so for us, we can be much more competitive on a rental or energy as a service business model than on a straight sales model. If we do sell the machine, we'll have very low margins, but we get some of that back as we wrap the service contract around under the FPP. But obviously, the benefit of our technology is it's not only greener, it's much longer life, it's more efficient, and it's much lower cost of ownership. So in a total cost of ownership scenario that renting equipment is, we're pretty much head to head with internal combustion engines.
Great. And how do you think about megawatts under management, and how do you see that growing over time?
Yeah, I mean, our energy service business is at 21 megawatts now, which essentially drives an EBITDA break-even result. At 50 megawatts under contract, we're about $8 million a year in positive EBITDA. So we want to drive from the 21 megawatts we just recently achieved up to that next level, which is 50 megawatts under rental. We have over 100 megawatts quoted. We've only been in the energy as a service business on the rental side for a couple of years. Obviously, that was during a pandemic. So we're looking for accelerated growth, especially in Bitcoin and cannabis and oil and gas over the next couple of years as we really drive that portion of our business.
Yeah, that's certainly a very exciting story. We're hearing more and more about megawatts under management from a variety of companies in the space. So let's now back it up and take a look at the big picture themes driving the industry. What megatrends do you believe are driving this sector globally, and how do you expect them to evolve over the next couple of years? And then, I guess, further expanding on that, how have you positioned Capstone to prosper in that environment?
Yeah, and I think the mega trends are pretty easy to see. You're seeing, the millennials and the Gen Zs, they're very environmentally sensitive. They're learning about it in school. They're understanding about mercury in lakes and air pollution. Obviously, global warming is something that everybody knows about and talks about. There's signs of it all over the place, changes in weather patterns, bigger storms, more frequent weather events. And so I think you've got a whole group of consumers and voters that are only growing in their environmental sensitivity. Almost every major country is signed up for some sort of climate, actions or rebuilding their economy in a green way after COVID. Obviously, our own administration has a lot of ideas in that area, but in general, you see ESG throughout investing. BlackRock, the biggest financial holders in the world, are pushing customers for more ESG. The SEC just came out with some new rules on potential rules on ESG reporting. So I think that trend and mega trend is only going to continue. I think more and more folks realize they can not only produce cleaner and greener energy, but they can do it in a sustainable way that's actually cost effective. And so the more cost effective the solutions become, the better off it is for all of us. And so 10 years ago, it was very hard to get customers to talk about carbon footprint or ESG or their impact on the environment. Now customers are coming to us saying, hey, we've got these goals that we came up with, or the board's given us, or our customers want us to hit, help us get there. So I think that's a huge change to our business. We were traditionally Capstone Turbine Corporation. As we looked at expanding the business to the energy as a service model, as well as adding more products and partners, we changed to Capstone Green Energy, and we've really positioned the company to be a green energy solution provider, which I think addresses that mega trend we're talking about.
Yeah, it's been an impressive transformation. So I suppose within that industry landscape that you painted for us, what is the competition like? What's the competitive landscape there? And what near-term obstacles do you believe you need to overcome, or the industry in general needs to overcome?
Yeah, we really don't have that many competitors besides the status quo. And I like to kind of say tongue in cheek that nobody ever got fired paying their utility bill, but maybe they should. And then the reality is it's about getting people to look at their energy costs, both electrically and thermally, and then figure out a better way to produce that energy themselves. And so I think as more businesses, especially energy intense businesses, look at managing their own energy future and their own energy costs and emission standpoints, they're going to turn to more products like ours. Fuel cells are higher electrical efficiency, but they're lower total efficiency than we are. They're about 5 times our costs. And so if it's an electric only customer, fuel cells fit better. If there's any thermal, either air conditioning, chilling, heating, cooling, steam generation, any kind of thermal energy at all, we're a better solution. Internal combustion engines are just like the automotive world, they're going away, just like engines in cars are eventually going away. Wind and solar are complementary solutions to us. And so wind and solar are not, firm power. We are. So our units run 24/7, 365. Many of our machines are used in conjunction with solar or wind or battery storage. And so it's part of a complete green energy microgrid. And so for us, our biggest competitor, frankly, is the local utilities and apathy and education for customers.
Yeah, that's interesting. So you don't really see wind and solar as competition, but rather as a complementary product.
Absolutely. No, especially solar. I mean, everybody should have, if they're in the right, climate zone, solar as well as our technology. You can't baseload solar. Solar does not give you resiliency. You can't use solar if the power goes out. It's got to be connected to the grid. You can't get any hot water, steam, thermal energy off solar in an efficient way. And so our machines running on multiple different fuels, everything from natural gas to biogas to hydrogen, can give you not only 33% efficient power, but if you take the thermal energy, you get up into 85-90%, and it's continuous duty, 24/7, resilient, power that's there all the time. So you add solar for peak shaving applications, makes a lot of sense. Battery storage makes sense if you've got big shifts in the customer's loads. And then wind, wind is limited in where you can find good wind resources. A lot of our customers, spotting a wind turbine in the middle of Manhattan is a little challenging, or in an industrial area. So a lot of areas where wind makes sense is more on the utility side, not so much behind the meter where we see our customers.
So speaking of your customers, I suppose, which industries do you believe present the most opportunity for Capstone going forward? Where do you want to lean into, so to speak?
Yeah, so it's really which customers are energy centric or heavy energy users, and then where are they in the world? And so if you're a energy dense customer, like a plastic company, a hotel, an industrial manufacturer, Bitcoin, cannabis, and you're in California or the East Coast, any place where power is over 10 cents, we're a great opportunity. If you're a intermittent customer with electric only, not much thermal energy, and you're in Seattle, where I'm from, not a great opportunity. You got cheap, hydropower there. So it's a combination of the energy density of the customer, and then where their region, where they are, what their cost of power is. And so the good news is we're seeing higher costs of power across the globe. And so areas that were not great for us before are becoming better areas as that utility rates continue to go up. I don't see any reason why utility rates will go down. And as we green up the grid, you're going to see utility rates get even higher. And then just everybody's, being tied to fossil fuels, like we're seeing in Europe right now with the war. Huge problems in Europe right now because of the dependence on fossil fuels from Russia.
Yeah, that's right. There's certainly a lot of geopolitical instability that could lead to more growth in this sector. And I guess on that topic, do you see opportunities within the recent infrastructure bill that may spur investment in your sector or broader adoption of your technology?
Yeah, probably the biggest areas would be through the U.S. Department of Energy for us, and we're waiting for some more opportunities to come down through the U.S. Department of Energy. So I think hydrogen development is going to get a lot of money spent on it from the infrastructure bill, and obviously EV charging, things like that are very good for us. From an EV charging standpoint, we've done multiple projects already where the grid and the infrastructure can't support the additional capacity. Our product's a great solution. We can take natural gas and make electricity for EV charging, especially remote locations. We can also use LPG or LNG or propane. The other thing, though, is hydrogen. There's going to be a lot of money spent on the development of hydrogen, both on electrolyzers as well as hydrogen operating equipment. We recently just announced our 30% hydrogen product. which is a blend of hydrogen and natural gas. And so as hydrogen develops, that's also going to be good for us going forward. And I do think the infrastructure bill is going to play a big role in that.
Yeah, excellent. So I guess we touched a little bit on investor demand in the space. Do you believe that Capstone qualifies as an ESG investment?
Yeah, I would definitely hope so. We're a green energy company. We've saved our customers about $750,000 or $750 million in their energy bills, about 1 million tons of carbon in the last 3 years. So we're definitely reducing carbon footprints. We're making investors more efficient. How green we are depends on the fuel and also what we're offsetting. But even on natural gas, we have a very green solution. Obviously on biogas, it's 100% green, or on hydrogen. So I think definitely it's a great technology that really helps folks lower their emissions and save money. And so I think definitely should be considered an ESG play.
So, we've seen a trend that many industries are seeking to bring power generation off the grid or behind the meter. And it seems to us, at least within the companies that we talk to, that there's a lot of desire to take this energy generation in-house. I guess, how do you help companies transition from being on the grid to moving over to this type of technology?
Well, first of all, if you've got a good grid that's highly reliable, we tell most customers don't completely go off the grid. That's usually not the smartest thing to do, but use the grid more as a peak shaving or a backup. And so we help customers install microturbines and solar and battery storage and allow them to produce 75, 80% of their own energy optimally in the most efficient way and the most economical way behind the meter, and then take that other 20, 30% of your power you need from the grid and use the grid as a backup in case for some reason your on-site generation plant were to go down. And so that's what we help customers do. To your point, I think customers are realizing if energy costs are your third or fourth or fifth largest spend of your business, and you're doing nothing to control it, then you're really not doing a good job as a manager, because that's something that, just paying your power bill blindly, having no control over future costs is not a great way to run your business. And it's a global economy. If somebody else is getting their energy cheaper and it's a big part of their cost of goods, then you're less competitive on a global scale.
I think you make a very good point there about seeing stress on the grid and managing around that. There's a coming wave of electric vehicle adoption, and that EV adoption is not without additional tax on the existing grid infrastructure. Do you think that the pressure put on the grid from that type of EV adoption will move more companies to have this type of off-the-grid power generation?
Yeah, you've already seen it start to happen in California, where the grid has struggled, especially on hot days where they don't have enough energy, especially with people adding more load. And so I think that's something that's already happened. You're seeing rolling brownouts and blackouts with PG&E because they're trying to avoid fires because of all the electrical assets that are up in the air and areas where they can start fires if there's a short. And so I think there's lots of stress on the grid already. As you continue to add more, remote charging and electric vehicle charging, you're only going to stress an already antiquated, unfortunately, grid. And as the grid is upgraded, which it needs to be done, then your cost of energy is only going to go up, and then the economics of your on-site project only gets better.
Yeah, very true. So, you mentioned California and the rolling brownouts that we've been seeing there. Do you expect that to perhaps happen in other states, other large states with aging grid infrastructure?
Yeah, I think you're going to see more blackouts, more brownouts in general. A big portion of the U.S. electric utility infrastructure is 1970s vintage, right? And so that's getting more stressed. You're putting more sophisticated equipment on it. As the economy grows, as population grows, as electric vehicles grow, all that's going to put more stress. And in different places, which the hardest thing for the grid is mobile charging and items that move around is very, very challenging. So I think in general, the grid operators are going to have more trouble going forward. And as they try to pull off more, older power plants that are dirtier, that's only going to make the grid that much less reliable.
Yeah, excellent. So we've received a question from the audience. Do you believe that you could give us some sort of outlook for revenue and EBITDA over the next few years, or a CAGR expectation?
Yeah, it's really hard for us to give revenue guidance. I think what we have said before is that at 21 megawatts of of rental units deployed, we hit a kind of EBITDA break-even level. So obviously the fact we're hitting that in March says that this upcoming first quarter, we're March year end, so the upcoming first quarter should be an EBITDA positive quarter for us. As we continue to grow that business, we'd hope to be EBITDA positive every quarter going forward, because over half our revenues, like I said, are recurring. As we grow that rental business, that's going to give us that EBITDA. And so I think for us, the next couple of years is about positive EBITDA growth and positive cash from operations, and that's the biggest stronghold for us. I think if we can do 20% revenue growth year over year for the next couple of years, that's very reasonable expectation. Obviously, there's more upside than that. I think one of the biggest limiting factors we may have, like many manufacturing companies right now, is just supply chain health and the ability to get more materials to grow much faster.
Yeah. Our next question has to deal with barriers to entry. What types of barriers to entry exist in this industry or for your technology in particular?
The biggest barriers tend to be the utility. We've never been turned down for a utility interconnect permit or an air permit, but they can sure delay them and make it complicated for you. They'll go to customers that we're doing a project and try to give them special pricing to kill the project. And so I'd say, electric utilities are definitely the biggest barrier we have to entry, though unless they come in and buy the customer, we tend to be very successful. Natural gas utilities, if they're not connected to the electric utility, are actually a big proponent of ours, as well as LNG, CNG, propane suppliers. So very much so, it's the electric utilities. And again, the other barrier is just customer education. They don't understand how reliable our product is and our systems are, and that it's really low risk to provide your own energy and take your energy destiny in your own hands.
Right. Our final question from the audience, I think is a good one. What do you think is most misunderstood about your story on the street? What is the buy side missing?
Yeah, I think the recurring revenue is the biggest piece. I think that when I look at recurring revenue and an investment, that usually garners a higher multiple. I think to have over half our revenue be recurring, high margin revenue is a big change from where we were. I think the rebranding from Capstone Turbine to Capstone Green Energy, a lot of folks on the street saw that as just a simple name change and a ticker symbol change, and it's not. It's much more than that. With the solar PV partners we have, the battery storage partners, we actually have a relationship with Baker Hughes, which is a much larger turbine manufacturer, and so we really put together a network of strategic partners, plus expanding the energy as a service business. So that's a very different business model than we were even a couple of years ago.
Well, Darren, this has been fantastic. I think it's been time well spent. And thank you so much for joining us on our Disruptive Technology Call Series. We look forward to talking to you again in the future.
Thank you, Brian. Much appreciated.
Thank you very much.